Focus in on the equity market, settling at 3,168 points yesterday. It really seems that the market failing to go anywhere right now. From Renaissance Capital's point of view, what is your outlook for the equity markets for February?
Thank you very much for having me on your show. I think, as you've stated, the market is still not as upbeat as it was prior to last year. I think for us, we expect that this year is going to be very volatile. We've seen a bit of a rally across some key blue chip names, KCB in point in particular. And I think what we're going to see is a bit of stock taking, especially once the financial companies start to announce. First one on this to announce will be Barclays Bank. So I think we'll just expect a more volatile kind of scenario where people actually come in, there's a rally, and then there's a bit of profit taking, which takes us to the levels that were seen towards the beginning of the year.
Overall, though, we know that the Kenyan market is cheap after it fell back quite significantly last year. So did Nigeria's market. If you had to look at the two markets from a valuation point of view, which one's most attractive to you right now?
I think if you look at them, the most attractive at this point is Nigeria, based on the Bloomberg PE index, which is at 7.3 times. Kenya is slightly above 8 times. And I think if you just try and understand the trading dynamics as well as the macroeconomic outlook, Kenya, we have a volatile market this year. So if you're a player in the Kenyan market, then you sort of need to position yourself as a hedge fund, taking profits under a shorter term period as opposed to going long term. But the converse is you have Nigeria, which has a strong economic outlook, growing at, say, over 8%, which has been the normal outlook for most of the investors. And the only risk in the Nigerian market that we see today is essentially the Boko Haram, which would actually be a key risk to the market performance if it was widespread. Beyond that, we look at the three key reforms in this market revolving around fuel reforms and electricity tariffs. And I think this most of these comments are actually contained in a publication we did in January, the Nigerian Dragon. And I think what we are saying is this positivity in terms of electricity tariffs, in terms of electricity reforms and subsidies on fuel, on the fuel reducing is a positive for Nigeria, because this have actually been key bottlenecks to this market. And overall, we think it's a long-term buy, especially at this point in time.
Let's move back to the Kenyan market, focusing in on one of the stocks which has been hard hit. Kenya Airways is that stock. You published a note yesterday saying that even though the stock is cheap, there are a lot of risk factors right now. We know that East African airlines are looking to position themselves in Africa. They're looking to connect Africa to the rest of the world, and that's pretty much what Kenya Airways' strategy is right now. What are the big risk factors that you're attaching to KQ's recovery?
Two key risk factors we cite in this report, as you mentioned, was published yesterday. The first is, in as much as this company is looking to connect Africa and more so East Africa to the rest of the world, you also have Ethiopian Airlines as also doing a similar thing. Ethiopian Airlines also has a 15-year strategic plan, which is almost similar to what Kenya Airways is doing in terms of fleet expansion and route expansion, with a focus on China, Asian markets, and also a focus of enhancing its connectivity in Africa. The other risk would be the risk of the Jomo Kenyatta International Airport in terms of increasing capacity, because the bulk of what Kenya Airways is trying to achieve is highly dependent on the parking availability, for instance, on the parking bays that are available at the airport. Because if you're moving your airplanes from X to Y, then you need to be able to have a place where you can park them. And also, if you're trying to be able to increase the number of passengers that you're bringing into Kenya and getting out of Kenya, using Kenya as a strategic hub, then you need to be able to have that kind of capacity. So I think these are the two risks that we are pricing into Kenya Airways. But this notwithstanding, there's also the risk of actualizing the fleet expansion through a rights issue, which today is still being held by the Capital Markets Authority. We've not had anything from that end in terms of approvals for that. But there's also the risk of raising that, because in essence, you're raising double what your market capitalization today is, and that may not be effectively taken on well by the minority shareholders of the company. That said, we are pricing it at 26 shillings based on a multiple pricing at a discounted valuation on an EV/EBITDA basis, but on a cash flow generation basis, we're pricing it at 18.2 shillings.
So still some upside there, but still a lot of uncertainty. Bamburi Cement saw some negative movements yesterday, down 1.5%. Seems foreigners were selling off the share, but that stock is on your buy list. What's the investment case for Bamburi in the construction sector right now?
I think for us, Bamburi again remains the largest player in the market, and it's not the investment case is not driven per se in terms of increasing market share or increasing revenues, but more of a cost containment story. Cost containment strategy. They're putting in a couple of strategies to contain their energy costs, which to date are about 60% of their total operating costs, and the plan is to reduce this to about 50% of total operating costs and enhance the company's operating margins. I think for us at a target price of 181, the current market price offers a good entry level for this stock, and essentially based on the dividend policy that this stock offers, which is over 8% at the current price. But more importantly, I think what we've been seeing on the pricing is, in essence, is a bit of supply from a local shareholder who's been looking to exit the stock, which we think is what's holding down the price. But should this trading dynamic change, then we actually expect to see more upside on the stock based on its fundamentals.
Mbithe, you also look at Rwanda right now, and of course the two of the stocks that are most actively traded there is Braliwa and Bank of Kigali. Are you banking on Bank of Kigali right now or the brewer?
We are still buyers of Bank of Kigali at the current price. Of course, it closed last month at a price lower than its initial IPO price. Comparing the two, Bralira is still on an upward trend, but I think the attractiveness to Bralira is based more on a dividend payout policy, which is something that Bank of Kigali doesn't have. But that said, the fundamentals of Bank of Kigali, we're pricing it at 136. The upside potential on this counter is looking very favorable, and also the macroeconomic environment of Rwanda is also looking much more favorable compared to its East African peers, so that the strategy of this bank in terms of enhancing its corporate products as well as getting into the retail market offers much more upside based on the current pricing levels.
Mbithe, we'll leave it there for today. Thank you very much for your time and insights. Mbithe Muema is an equity research analyst from Renaissance Capital.